the International Monetary Fund, or IMF, recently released a report about global currency reserves. Despite the trend of de-dollarization, they do not see a rapid shift happening anytime soon. This means that countries will continue to hold a significant portion of their reserve in the US dollar, which remains the dominant currency in the international financial system. However, the report also highlights the need for countries to diversify their reserves to mitigate risks in case of a sudden shift in the global economic landscape. The IMF recommends that countries consider including other currencies, such as the euro, yen, and yuan, in their reserves portfolio. Some countries, like China and Russia, have already been
cash flow, who has actually got profitability, who is making things, and there's a big story running in the background, and obviously you've been talking about it for the last week or so, which is this de-dollarization story. Now, this isn't about a collapse of the US dollar, but it is about a need to diversify. And what is EM? Emerging markets. What is sort of non-US? And it's essentially, I think the world's going to break to the US plus Europe in one camp, and the rest of the world in the other. And I think people are going to start to look around and say, okay, well, maybe I, like Warren Buffett, I should be looking at Japan, maybe I should be looking at Southeast Asia, not just because of the old correlations between a weak dollar and EM markets, but actually say, well, okay, US growth might slow, but US growth isn't what it's all about anymore. There's a whole non-US block that's growing, and who's out there, what's going on there, which companies are having IPOs, which companies are raising capital, who's issuing bonds, who's issuing foreign currency bonds, foreign currency equities, and I think there's going to be a sort of re-internationalization of flows. So it's not all about just looking at the US economic data.
I think you make a very interesting point. I think the world's dependence on US growth definitely is coming down, Mark, but I don't know whether the de-dollarization story is something that has legs as of now. I was just looking at some data, and between 2000 to 2020, dollar reserves as a percentage of total global reserves came down from 70% to 60%. It's taken 20 years for that 10% adjustment. So what is to say that, from here things will speed up? I was talking to a guest yesterday, and I can't name names, but I was talking to a guest offline yesterday who was saying, not in our lifetimes, the dollar would be king dollar for another good couple of decades.
Well, the thing that changed, of course, was a year ago when the US froze the foreign exchange reserves of Russia. And everybody who's basically we've had the petrodollar system since 1971, where basically everybody had to trade in dollars and they were happy to reinvest those dollars into dollar assets. If you now find that if you disagree with US foreign policy, you risk having those confiscated or frozen, you've got to have an alternative place to put those assets. So that's the catalyst. This is what has changed. So which is why, prior to last year, you were right, it was a very slow decline. This isn't about the US being replaced as a reserve currency. This is very, very important. There's lots of issues around being the reserve currency you don't actually want. What this is about is that when China buys oil from Saudi Arabia, it doesn't have to buy it with dollars. And this is actually very significant in terms of the trade figures you were talking about this morning. Because in the old days, China would have to have sold stuff in dollars, probably to America, in order to earn enough dollars to buy its oil. Now it doesn't actually have to do that. And so it's cutting out that middleman. And what then happens is, look at those exports. It's now much higher value-added exports that China is selling. It isn't about selling cheap stuff to Walmart, keeping down the prices for American consumers in order to earn the dollars to buy its energy. This is now about actually a completely bilateral trade bloc. And why would you devote your economy to making cheap stuff for Walmart when actually you can make EVs and you can make higher value-added things and challenge Germany, challenge the US? So it's a big shift in the composition of trade is really the story behind it. This isn't about whether king dollar or not. This is basically saying there's a big, because 80%, 90% of trade goes through dollars, right? So there's $6 trillion a year of global trade, and there's $6 trillion a day of FX volume on the back of that trade. So you start cutting down the amount of trade that's in dollars, and then the whole thing has to shrink. So there's big long-term implications for markets, which we need to think about. And it's not a, oh no, they won't, not in my lifetime, oh no, they will. I mean, people are actually having to think about capital flows, strategic allocation, and basically, this is as big a deal as 1971 when the US came off.
Having no exposure to China tech, primarily because he thinks the regulatory risk is very much still around.
So with the China internet results season now, mostly with Baidu, Alibaba, Tencent reported, most of the earnings were a beat. We're talking about cost controls, cost discipline across the board. And while I think the e-commerce numbers do show some of the recovery on a one-year basis, on two-year basis, we're also seeing some signs of this consumption is gradually recovering. It's not as fast as what the market or our investors were hoping for back at the end of last year, but it's gradually recovering. I think Alibaba and Tencent talked about the payment numbers, particularly Tencent payment numbers that are showing that consumption, if you add the online and offline together, services have been strong, travel has been strong, and goods kind of started to really pick up in the month of March with apparel. And so Alibaba have seen that strength. I think beginning of year, we said advertising is our top preferred pick. We think e-commerce competition will be more intense this year as the reopening will impact some of the online retail. But with the divergence in performance year to date with advertising plays, Tencent seeing good advertising growth. With e-commerce lagging, we actually see some select good opportunities within express delivery and select e-commerce names as we head into the second quarter, into the June 18th shopping festival, where we expect some of the attractive pricing to drive better demand in the online market.
Right, but how do you deal with, I get your point. I understand that things are changing for the sector as a whole. There's a fair amount of online demand coming back. China's reopen is auguring well for these businesses. But is this trade being backed by investors? Are you seeing money flow into these stocks primarily because, like I said, they're still scared of the regulators?
I think on the regulation front, Tencent and a few of our management teams talked about that the regulations within the country in China is more adaptive. It's more supportive of platform businesses. While we do see some of the investors were concerned about more on the US side on regulations on AI and anything about investment bans or anything of those sort into the China tech and AI front. But if we look back to these businesses, most are massively dominated with domestic consumption. Online penetration indeed has grown through the years, so consumption and online retail is converging. But we do see a lot of the capital allocation and returns, with Alibaba overnight was announcing this distribution of Ali Cloud. And this would imply nearly around 18% of our some of the parts of Alibaba that's given to shareholder. Earlier, Tencent over the past 2 years distributed JD shares, Meituan shares, and most of these companies are upping their share buybacks as well. So we're in very attractive valuation terms, talking about Alibaba at 9 times PE, or actually on the underlying Taobao Tmall business, which I think they commented on being more aggressive with a 3-year plan of investments that might have caught sort of concerns of investors, whether this margin improvement profile that investors were expecting will continue. We do think with these spin-offs, their loss-making assets will start to turn narrow in loss and turnaround. This gives Alibaba the room to reinvest while delivering the shareholder returns that most investors are hoping for. So we think at these we're in a juncture of some of the geopolitical or concerns, but at the same time, these stocks have turned to a very attractive valuation. So we do see some of the comeback in investor interest across the space.